Ladies and gentlemen, hold everything. Stop scrolling, stop trading, stop whatever you're doing, and pay attention right now. Physical silver is vanishing from the New York vaults at a record jaw-dropping speed. We're talking millions upon millions of ounces yanked out of COMEX warehouses in days. Registered inventories hemorrhaging, eligible stocks getting raided, bars flying out the door faster than anyone can blink. This isn't a slow bleed. This is a full-on exodus, the kind that happens when the system cracks and reality starts overriding the paper game. And while Western screens show spot prices dipping or flatlining, China is quietly, but aggressively, paying a $9 premium over the COMEX price just to secure physical metal, $9 an ounce extra. Think about that. Buyers in Shanghai aren't haggling. They're paying up big time because they need the real bars, the real coins, the real silver for solar panels, electronics, batteries, defense, everything that's exploding in demand. They're not buying paper promises or futures contracts. They're buying metal, and they're willing to outbid the West to get it. This is the smoking gun, folks. The paper market in New York and London can print contracts endlessly, leverage, shorts, derivatives, naked claims, but physical silver doesn't multiply in a vault. Mines aren't ramping up overnight. Ore grades are declining, supply is tight, and the structural deficit is widening every single day. When China pays $9 more, it means the arbitrage door is wide open. Metal flows east. Vaults in NY drain even faster. Premiums widen, lease rates spike, and the whole fragile paper pyramid gets another crack. Most people look at the ticker and think correction or volatility. I'm telling you, this is divergence screaming at us. Paper price can be manipulated short-term with margin hikes, spoofing, and forced liquidations. But physical reality doesn't lie. The bars are leaving. The demand is insatiable. And when the last ounce that can flow gets vacuumed up, the paper price won't lead anymore. The physical squeeze will. Today, I'm breaking it down crystal clear. Why NY vaults are emptying at record pace. What China's $9 premium really signals about global scarcity. Who's winning the physical tug of war. And, most importantly, what this means for anyone holding silver or thinking about stacking more before the window slams shut. Because this isn't just news. This is the prelude to the next violent leg higher. The drain is the warning shot. Stay locked in. Physical silver is getting vacuumed out of New York vaults at record speed. Millions of ounces gone in days. Meanwhile, China is quietly paying a $9 premium over COMEX just to secure real bars. This isn't normal demand. This is the physical market overriding the paper lie, and the squeeze starting to build. The numbers coming out of COMEX are staggering. Registered silver inventory, the stuff actually available for immediate delivery, has plunged at a clip that shatters every precedent. We're seeing single-week outflows in the millions of ounces, with daily pulls sometimes hitting levels not witnessed since the height of past bull runs. Eligible stocks, the broader pool, are being raided too as metal gets re-registered and withdrawn. Trucks roll up, bars get loaded, and the metal vanishes, often headed straight to cargo planes bound for Asia. The vault levels are dropping so fast that analysts tracking the data are updating charts almost hourly, and every update shows deeper red. This isn't some seasonal quirk or routine rebalancing. It's a structural exodus driven by insatiable real-world hunger for physical metal. In China, the premium tells the full story. Buyers aren't nibbling at spot prices. They're aggressively bidding 9 or higher, above the COMEX benchmark, to guarantee allocated bars land in their hands. That $9 gap isn't trivial. It represents a massive arbitrage incentive screaming that the true value of deliverable silver far exceeds whatever the paper futures market is pricing right now. Chinese industrial demand is exploding. Photovoltaic manufacturers installing gigawatts of solar capacity monthly, electric vehicle and energy storage battery, producers scaling production lines, 5G infrastructure and semiconductor fabs, consuming silver by the ton in conductive pastes and contacts. Add in jewelry demand during cultural peaks and private investment stacking, and the appetite becomes relentless. These buyers aren't playing games with unallocated pool accounts or paper derivatives. They demand physical possession, kilobars, 1,000-ounce good delivery units, whatever form ensures the metal is theirs and can't be rehypothecated. They're paying the premium because waiting for a dip in the manipulated spot, price risks missing out entirely. Domestic Chinese mine output can't bridge the gap. Global supply remains constrained by declining ore grades, permitting delays, and rising extraction costs in major producers like Mexico, Peru, and Bolivia. Recycling flows help marginally, but nowhere near enough to offset the widening annual deficit that's now measured in hundreds of millions of ounces. The paper market, meanwhile, continues its illusion of abundance. Futures contracts multiply with leverage ratios that allow massive short positions to dominate. Algorithms spoof volume, margin requirements get hiked strategically to trigger cascades, and coordinated selling pressure can drive prices lower even as physical metal flees the system. But leverage doesn't create bars. Shorts don't magically summon silver from nowhere. When the arbitrage window stays propped open at 9ers, 10ers, or more, the flow becomes one way, out of Western vaults, across oceans, into factories and reserves where it disappears from public reporting. This dynamic is the core of the squeeze mechanism. Every ounce withdrawn tightens available supply on COMEX. Delivery notices on expiring contracts rise. Backwardation appears in near-term spreads as borrowing costs climb. Lease rates for physical silver spike because lenders become reluctant to part with what they have. The paper price might lag or even dip temporarily under suppression, but the underlying tightness builds pressure layer by layer. Western retail investors might see lower spot quotes and hesitate, assuming weakness, while the physical market operates on a different timeline, relentless, indifferent to headlines, and accelerating. The divergence is no longer subtle. Vault drains accelerate, premiums persist and widen. Industrial offtake ignores paper volatility. Asian demand pulls harder. The system strains under the mismatch between infinite paper claims and finite physical reality. History shows these setups precede explosive moves. Corrections flush leverage. Drains concentrate scarcity. Premiums signal the tipping point. And when the paper facade finally cracks, the rebound isn't gradual. It's ferocious as trapped shorts cover, and real demand overwhelms what's left. The vacuuming of New York vaults and China's willingness to pay $9 extra aren't isolated events. They're coordinated signals that the physical market is taking control. NY vaults draining fast, China paying up big, $9 over spot, for physical metal they can't get enough of. Paper price can be suppressed, but bars don't lie. The divergence is screaming, physical scarcity is winning. And when the last ounce flows east, the paper game ends in a violent upside explosion. Stay stacked. Right now, the COMEX warehouses in New York are bleeding silver at a pace that's breaking every historical record. We're not talking gradual outflows over months. Millions of ounces, registered bars ready for immediate delivery, are being pulled every single week, sometimes in single-day hauls that dwarf anything seen in the past decade. Eligible stocks follow suit as metal gets reclassified and shipped out. The vault cameras might as well be showing a conveyor belt running non-stop to the airports, because that's exactly where a huge portion is headed, straight to Asia. Meanwhile, in Shanghai and across Chinese markets, buyers aren't waiting for the paper price to bottom. They're stepping up and paying a staggering $9 premium, sometimes more, over the prevailing COMEX spot just to lock in physical delivery. $9 an ounce extra isn't pocket change. It's a massive signal that the real metal is worth far more than the manipulated futures ticker suggests. These aren't speculative traders chasing momentum. These are industrial giants, solar manufacturers cranking out panels at record rates, electronics assemblers feeding the AI and 5G boom, battery producers scaling EV and energy storage, plus state-linked entities and private stackers who understand that ounces in hand beat ounces on a screen every time. This premium isn't hidden in back channels. It's visible in dealer quotes, in arbitrage flows, in the frantic bids on physical auctions and OTC deals. China isn't buying futures contracts or unallocated pool claims. They are demanding allocated bars, kilo bars, 1,000-ounce good delivery units, whatever form they can get their hands on. And they're willing to pay the toll because domestic supply can't keep up. Imports are throttled by quotas and logistics, and global mine output remains stubbornly flat despite higher prices. Ore grades decline year after year. New projects face endless delays. Environmental crackdowns hit hard in key producing nations. The math is brutal. Annual mine production plus recycling falls hundreds of millions of ounces short of consumption. That's only accelerating. The paper market, by contrast, operates in a fantasy world of infinite leverage. One contract controls 5,000 ounces with minimal margin. Shorts can pile on, spoof orders can flood the book, margin hikes can force liquidations, and price can be driven lower to whatever level suits the big players. But none of that creates a single additional physical ounce. When the arbitrage window stays open, $9, $10, even higher premiums, the metal flows where the real demand is. Eastward, out of New York, out of London, into factories, into reserves, into private vaults where it disappears from public view. Every ounce that leaves COMEX tightens the noose a little more. Registered inventory drops, delivery notices spike on futures expiries, backwardation creeps in on near-term contracts, lease rates climb as borrowing physical becomes expensive. The system strains. The divergence widens. Western retail might see a dip and hesitate, but the physical market doesn't pause. Asian demand stays relentless. Industrial offtake doesn't care about headlines or red screens. It needs silver now, tomorrow, next quarter, and it's taking it regardless of price suppression tactics. This is how squeezes are born, not with fanfare, but with quiet, relentless draining. The paper price can hover or even drop short-term, while the underlying reality shifts irreversibly. Vaults empty. Premiums persist. Arbitrage pulls more metal away. Leverage unwinds violently when reality finally bites back. The ones paying $9 over spot today aren't gambling. They're securing position before the door closes. The rest watch the ticker and miss the signal entirely. Physical scarcity doesn't negotiate. It accumulates pressure until something gives. And when it does, the move isn't measured. It's explosive. So there you have it. The New York vaults are being stripped bare at record speed, millions of ounces vanishing into thin air, while China steps up and pays a fat $9 premium over COMEX just to get their hands on real allocated bars. This isn't speculation. This isn't hype. This is the physical market screaming the truth while the paper game plays pretend. The divergence couldn't be clearer. Paper can be manipulated with leverage, shorts, and spoofed orders to keep prices suppressed short term. But physical silver doesn't multiply when someone hits print. Mines aren't suddenly producing double output. Ore grades keep declining. Industrial demand, solar, EVs, electronics, defense, keeps exploding. Recycling can't plug the gap. The structural deficit widens every month, and now the arbitrage is so wide open that metal is flowing east faster than ever, draining Western vaults and tightening the noose on COMEX deliverable supply. This is how real squeezes ignite. Quietly at first, vault drains, persistent premiums, backwardation creeping in, lease rates climbing, then all at once when the paper facade cracks and reality floods in. The ones paying $9 extra today aren't gambling. They're positioning before the door slams shut. The weak hands who sell on dips or chase paper dips will regret it when the physical squeeze forces the next violent leg higher. If this breakdown cut through the noise for you, smash that like button so more people see what's really happening in the metals market. Drop a comment below. Are you stacking more physical silver right now? What's your average cost? Have you noticed premiums in your local market? Or are you waiting for the paper crash to bottom? Share your thoughts. Your comments fuel these deep dives. And if you're not subscribed yet, hit that subscribe button and turn on notifications. These moves accelerate fast. Vault drains, premium spikes, delivery notices exploding, and I break them down raw. No fluff, no corporate spin, just the unfiltered truth on silver, gold, and the bigger macro game. Don't sleep on the next update. Stay physical. Stay ahead. Stack while you can. I'll catch you in the next one.